if I said, hey, I got to sell my home tomorrow, Mike, will you buy it from me? You're probably not going to pay market rate. You're going to get a significant discount. So, that liquidity that you are paying for, essentially, you're getting a premium, and you're also getting stability for that. And that's one of the reasons this real estate is great.
All right, everybody, welcome back to the Richer Geek Podcast. I'm excited to have this episode is Chris Larsen. How you doing, Chris?
I'm doing great, Mike. I'm excited to be here.
Yeah, so Chris, you are a real estate investor, author, sales exec, prior engineering nerd, which we all love here on this podcast.
Still a nerd, but no longer an engineer.
and you are now the founder and managing partner of Next Level Income. Tell us about it.
Yeah. So, you touched on a few things there. So, Mike, I was an investor before I was an engineer. I was in engineering school at Virginia Tech, studying biomechanical engineering. Studied that for 4 years before doing an MBA in finance. And I always joke. I said my advisor pulled me aside and said, Chris, you're not smart enough, and you got too much personality to be an engineer. And I just looked around, and you think you're smart, and then you get to a level where you're in these PhD level classes, and you just see how smart these people that your colleagues are. And I always say I was smart enough to understand the concepts and convey them, but I figured you'd want somebody else designing the bridges and the different things. And I was lucky enough. I found a career in medical device. You mentioned I was a sales executive. I was in sales for about 18 years combined. Loved it. I got to probably the best part was I got to work with the engineers that were designing these implants and these products. And I got to be in the OR and work with the neurosurgeons and the orthopedic spine surgeons that use the products on patients. And I got to be the person that conveyed the information and provided the service in between. So I really, really had a great time. And a lot of people are like, Chris, why on earth did you go to engineering school and put yourself through that torture to do this? And it certainly was torture at some points. But I will say the thought process of an engineer, and if you are an engineer, you know what I'm talking about, the methodology of looking at assumptions, breaking it down, iterating through the process and making it better really served me well throughout my career. And my investment career specifically over the past 20 years. So today, our mission at Next Level Income, Mike, is to provide investors a shortcut, the education, as well as the opportunities towards financial independence.
And that is exactly what our listeners are looking for, because they know, we talked earlier, everyone knows that in today's world, the 401k, the IRA, the stock market with, China sneezes or something happens and bam, it's just the heartache and stress. And it's so nice to have, to be able to diversify, to be able to have the funds to be able to diversify. And through your company, is it now multifamily is your niche, would you say? Is that what you're doing?
Yeah, great question. So my book, I talk about the holy grail of real estate, which is multifamily. And if you'd like to get a copy of the book, you can get it for free at nextlevelincome.com. You can just click on the book link. It talks all about my story. And it talks all about multifamily and specifically value add multifamily. And today we do about 80%, Mike. 80% of what we do is multifamily real estate. We also do self-storage. We have some other one-off opportunities. We're doing a mobile home park deal right now, which I really like for affordable housing. And you can, we talk about a lot about stuff on our website. You're not going to see any opportunities to invest in there, although you can click invest and you can learn more about what we do if you're interested.
And what are you seeing in the market today? Now, I think self-storage has and always will do well. Mobile home parks is like, if you can get one, that's kind of like the cash cow of the industry. The multifamily that you're finding now, are you East Coast only, or are you kind of expanding out into the rest of the United States with your multifamily?
Yeah, so my engineer is going to show through. So I'm going to touch on a couple points. Um, you mentioned a part about diversification. I talked
Uh-huh.
about in my book why I like multifamily, because it allows you to decrease the risk in your portfolio while increasing, or even if you decrease the risk and maintain your return, right? That
Hmm.
provides a nice benefit. So when I was looking at where to move, we were in the DC area starting out my career. I said, all right, what are areas of the country that are going to have nice demographic tailwinds, nice demographic rising tides, both from a career perspective as well as a real estate perspective. And we're talking about 15 plus years ago, and the Southeast really rose up. And the reason the Southeast rose up is because higher quality of life, lower cost of living in the Southeast. We moved to North Carolina specifically for those reasons.
Hmm.
So today we focus on the Southeast for the same reasons, for the same demographic reasons in the multifamily space. So the markets we're targeting, Mike, are the Carolinas, North and South Carolina, markets like Raleigh, Charlotte, Greenville, Charleston, as well as Atlanta, Georgia, some markets in Florida like Orlando, where we just made 2 acquisitions. We're also looking actively in Texas, Arizona, although we don't have any properties there currently. So I think there's a lot of strong markets. I mean, you're right next to one of the strongest in the country in Phoenix.
Hmm.
I see some great deals come out of there, but we focus 95% currently on the Southeast.
And having invested in those, if I were to invest, some of the questions that I would have uh, in regards to the multifamily, I know here in Arizona, man, the cap rates are just so small right now because
Yeah.
we have the Canadian buyers and the California buyers are just coming in and bam, and we're down 4 cap, 4%, 3.9, it's getting. Are you seeing that? And are you scared about that? Or you're like going, what, there's still appreciation, what is the play? Are you still doing that? Regardless if it's that low, or is it higher where you're at?
Yeah, I think it depends on the market. It depends on the deal. It depends on if you're looking at multifamily, self-storage, mobile home, whatever that is. But let's talk about multifamily. And I agree. You guys are seeing some really low cap rates out there. I was looking at a deal out there last week, and it was in the threes for I
Yeah.
want to say it was an 80s vintage, 70s or 80s vintage.
Mm.
So what we're seeing for Class A products, we're talking about stuff that's been built in the last 10 years. We're seeing fours. We're seeing mid fours, sometimes low fours for brand new product that's out there. But we're talking about luxury product in
Yeah.
the Southeast where you're looking at that. As you go up the chain, here's the interesting thing. You're not seeing massive differences in C plus and B. You're seeing maybe 100 basis points difference. So I think it's all relative. You have a lot of newer investors that are coming into the market looking for these older value add deals, and they're paying, in my opinion, a premium. I would much rather pay a 4.5% cap rate for a 2018 built product than a 5 cap for a 1974 built product. And these are real numbers that I'm seeing. I'm even seeing in the fours for that same 70s vintage. Now, it's all relative. If we look around the world, we see a lot of money flooding into the United States. You were just talking about California and Canadian buyers. You look at Asian buyers, money coming from overseas in both directions. It's because there's liquidity and there's not a lot of yield if you look around the world. So, it's like, where do you put your money? Do you put it in bonds? No yield. Do you put it, in international markets? No yield. Cap rates around the world in developed countries are even lower. So I think there's still opportunity. And I think you have to be you just have to be very conscious about that. And the flip side is, if you look at a deal and you say, hey, I'm buying it at a 4 cap, are you going to assume that's going to go down to a 3 cap? I would say that's not an assumption I would personally make. I'd say maybe you assume cap rates expand a bit and make sure you're comfortable with that. If you're banking on cap rate compression for your returns going forward, there's probably a little bit more risk in that than it was 5 years ago when we were buying 6 caps.
Yeah, that's some great points. And some of the people that have invested with me, and I'm sure you can say the same. One of the things is, well, I can throw it into a bond, right? I can get that 4.5%. And they're not thinking, all the other advantages we have being in real estate that your bond isn't going to give you your mutual fund. So give me some of the highlights of, yes, you can go 4.5% all day long in other different markets, but what does real estate give you?
That's a great question. So there's a few things, and I actually highlight this in my book. So if you're listening to anything I'm saying here, I dig deep into almost all these topics in my book, whether it's how we select markets, or what you would call the Sharpe ratio. What the Sharpe ratio is, that measurement of risk versus reward, that risk adjusted return, and what high quality multifamily assets provide a bond like risk with a stock like return. And if you look at the stock market, if you look at the bond market, we're at historically high levels in both of those right now as well. So if bond yields rise, so if we're at let's say we're at a 2% yield on a bond and interest rates rise to 4%, you're going to lose 50% of your value in your bond. That's a massive loss of capital, right? Like 50% loss of capital is very high. If you're in stocks today and the market loses 50%, which is possible, maybe it loses 30%, maybe the bond market loses 30%. That's a big loss of capital. If you're in a multifamily deal and you're getting, let's just say a 5% cap rate, right? First off, you're not accounting for leverage, right? So if you pay all cash, maybe you're getting 5%. But I'm going to tell you that if we're buying a property at a 4.5 cap, we're getting higher than that in yields to investors because there's leverage involved with respect to that. And we're buying properties that are cash flow positive. There's also value add that can, even in a 2018 built property, think about it. If you buy a property that was built in 2018, when was that property initiated? Probably about 5 years ago. So if you and I are putting together plans for a property today in Phoenix, we're probably going to have different finishes than we would in 5 years from now. The market's going to shift. It's going to change. There's going to be different preferences. So we're buying properties today that people are like, oh, those are only 2 years old. But I'm saying, well, yeah, Mike, but these have finishes from 5 years ago and they need to be updated. So there's a value add component there. And that's where these cap rates cut both ways. If you buy at a 10 cap and you increase income $1, you've increased the value of that property $10. And again, I walk through this in my book. So I've got a lot of smart people listening. You're probably following. But if you increase the value of a property, the income of a 10 cap property, $1, you increase the value $10. If you increase that same property at a 4 cap, $1 in income, a $25 increase in value. So as cap rates compress, there is more leverage when it comes to value creation. So if you have, I'd say if you have cash flow opportunities and you're comfortable with the business plan, you still can have value add in these newer properties that are lower cap rates and still get overall total returns that are very competitive with the stock market, but still have a lower risk profile.
That's excellent. And you haven't even touched on the wonders of the K1 and
tax benefits, right?
Tax benefits.
Yeah. Icing on the cake.
That's the icing on the cake is looking at the depreciation, accelerated depreciation that all of us do, when we buy large products.
So let's add some icing to the cake. So, and that's the thing. If you're getting now in a municipal bond, you might not be paying taxes, and there are tax deferred or tax free options out there for investors in the bond market and other investment opportunities. But most of our investors, they are getting this income, these returns, tax deferred. I hesitate to say tax free because the government always is going to come for that, whether you have a 401k as tax deferred or a Roth IRA where you've paid tax, life insurance or real estate. But it is tax advantage. So I'd say, hey, if you're getting a 6 or 7% return, but that's after tax, what do you have to get in a similar bond? Probably 8, 9, maybe even 10%, depending on what tax bracket you're in. And that's going to be hard to find in a high quality bond.
And no matter what the economy does, real estate will always, okay, I hate saying always, it has a much better chance and has proven itself over the decades to always recover and appreciate.
Yeah, I'd say, I mean, I agree with you. It's less volatile, right? And investors say, well, Chris, if I invest in this, it's not as liquid as a bond. It's not as liquid as a REIT. And I agree. Like there is a liquidity cost that you have in real estate, and you have that whether you own a house. If I said, hey, I got to sell my home tomorrow, Mike, will you buy it from me? You're probably not going to pay market rate. You're going to get a significant discount. So, that liquidity that you are paying for, essentially, you're getting a premium, and you're also getting stability for that. And that's one of the reasons it's real estate is great. People can't move on a dime either. They have to have somewhere to live. So the reason people have to have somewhere to live, the reason people can't sell their house immediately, all these things help the stability of this asset class, which, I've loved it for 20 years.
Yeah. So have I. It's wonderful. Now, something that's in your book I think it's in your book that you've talked about is establishing a family bank through infinite banking concept. What is that?
Yes. So I was a licensed insurance agent almost 20 years ago. I got relicensed. I had to have something to do during COVID. So I went and got my life insurance license all over again. So I rewrote my book about a year and a half ago, and I added a chapter. I had chapter 3, and chapter 3 is called Your Opportunity Fund. So your opportunity fund, simple. If you're listening, I ask you, what are you doing with your money in between deals? So if you're going to invest $100,000, where is that money going right now? Is it going into a checking account, a savings account? Is it going into the stock market? I have investors that say, oh, I got to sell some of my, company stock. And that's risky to keep your money in the stock market in between real estate deals if that's where you're going to allocate it. My preferred place is in cash value life insurance. And there's a concept called infinite banking. Becoming Your Own Banker that Nelson Nash wrote talks about how to use whole life insurance, cash value life insurance, basically is your own bank. And a lot of people are going to hear whole life insurance. And if you're listening, you're thinking, oh, life insurance expensive. And you know what? I learned the same thing 20 years ago. Oh, Chris, buy term, invest the difference. And I sold a lot of term insurance back then. However, what I learned, and this is why we're talking about real estate, Mike, and I talk about it in my book, I want to know how the ultra rich invest and the ultra rich handle their money. And one thing the ultra rich do is they invest 20 to 30% in income producing real estate, just like big pension funds. The other thing they do is they buy a lot of high cash value life insurance. It had so many tax benefits at one point that Congress went and they enacted new tax laws in the 80s to restrict some of those because people were sheltering so much money. But to put it simply, what you do is you work with a professional that understands how to structure one of these policies, and you optimize it to maximize the cash value, minimize the cost of the insurance, and then you use that cash value to invest. And that's what I call your opportunity fund. And what you can do is you can put the money into the life insurance. While it's in the life insurance, you're getting the value of the life insurance. You're also, if it's properly structured with the right company, you're getting a dividend. So you're getting dividends that come back, and those are typically returns of premium. It's not taxable. So it's almost like a bond, like we were talking about earlier, and it can be tax-free. And this is something that actually can be tax-free because you already paid tax before you put it in. This is not tax deferred. It's already tax-free. And then the cool thing is, again, if it's properly structured, let's say you have $100,000 of cash value, you can pull that money out, keep getting the dividend, and invest it somewhere else. And that means you're using it in two places at once. So I know what you're thinking. You're thinking that's too good to be true. There is a cost associated with it. It typically takes 5 to 7 years to get these policies to the point where they're break even. So it's like starting a business or going to college. Like there's a cost associated with it, but there's a big payoff on the back end. And if you are a cash flow investor, or you want to send your kids to college, or you're a business owner and you have a need for liquidity, like I did a little over a year ago when COVID hit, I pulled a couple $100,000 out of our policies and stuck it in my bank account. I told my wife, hey, we're finishing a house. I don't know if we're going to make any money the next 3 to 6 months, but you know what? We're going to be good for the rest of 2020. And I'll tell you what, that peace of mind, knowing if something happens to me or if I need that money, if there's an emergency, that there's a lot of value associated with that as well.
Now, how does that work? Are you basically doing a loan against your policy? Is that when you take things out, and then you have not only did you take some money out, but then is there an interest? So you're actually paying yourself back at an interest, or how does that work? How you can't just pull money out, right?
Correct. Yeah, there's a formula to it.
Mm-hmm.
So, and I walk through this. We have a white paper. If you go to my website, nextlevelincome.com, click on the banking link, and you can get some more information there. And again, this is why it's important to work with a professional to kind of shepherd you through this process. But you're correct. You actually pull the money out as a loan against your policy. Now, think about this. Life insurance companies, they invest their money in things like high quality real estate, high quality bonds, government bonds, city bonds, these sorts of things. They have to make a return because they have to continue to grow the money over a period of time to pay the claims. It's all a formula. It's done by actuaries. Again, we're talking to a highly educated audience here, and it's all numbers and formulas to keep the risk down. And insurance companies have to earn a spread above what their expenses are going to be to remain solvent. We're talking about companies that are older than the IRS. They know what they're doing. Okay. So when they lend you the money, the first person they want to lend that money out to is the policyholders. So think about this. The policyholders, the collateral is your life insurance policy. What is more secure than the life insurance policy that the life insurance company owns? So they may lend you the money at 5%, but you may be getting a dividend of 3, 4, 5, 6%. To offset that. Again, if it's properly structured, you're going to continue to get that dividend even if you get that loan. So your net spread on the money you borrow, it's not the 5%. It's typically significantly lower than that. So you have to be smart. You can't take them. Well, you can, but I wouldn't take that money out and go buy a boat, for instance. I would take that money out, and if I'm going to use it somewhere, I would put it somewhere that has a nice, secure return. And then when you get that money, you put it back into the policy. And I think this is what you're talking about, Mike. You pay yourself back essentially with interest. And then when that money goes back into the policy, remember, it's still earning the dividends that have been in there. You pay it back with interest. That interest goes back into your policy to you, and then it continues to grow. So that policy grows inside of the cash value continues to grow inside of your policy as you pull money in, put it back, pull money out, put it back in. And then as you get to the point where you need it for retirement, you have access to those funds. And again, that can be done tax-free, where you pull that money out of your policy, and it can be used almost like your own personal pension plan. And if you have a pension, you're listening, you're very fortunate. Some people don't even know what that is now, but it's essentially your own personal pension fund. So we have that. We have our life insurance. We have our real estate investments. So we have multiple streams set up when it comes to, I say retirement. I don't really like to use that word retirement, but when it comes to our future cash flow needs.
Yeah. And I don't like the retirement either, because what's nice is, for us, general partners, you don't have to retire, because it's just, it works. We have people, and it just kind of works, and we don't have to be that involved. That is our goal in the future. But for passive investors, it's something that it's fun. Instead of just waking up in the morning, going to your paper and say, okay, well, how much did my stocks lose or make? Now it's like, wow, I own a piece of this multifamily and this self-storage, and to me, it's a little more exciting than just seeing if your stocks went up or down, or
It is, and the neat thing is, these communities that we own. I was on another podcast earlier today. We're looking out for our investors, of course, but in the process, we're actually improving these communities that we're buying. We're going in and sinking, most of the time, millions of dollars into these apartments. So the residents get a nicer place to live. It's nicer outside. I take my boys to every property we buy. I show them around. I tell them what we're going to do. I say, hey, what do you think about this? What do you think about that? My wife's an architect. She tells me how she doesn't like to paint most of the time of the places we buy. And, and you can choose to invest your money in a place that is going to, not just make you money, but also do good for the community.
Mm-hmm.
And, it's cool. And you can do that. You can do that through the stock market as well, through different companies, but it can be a real win-win for not only investors, but also the people that are using that real estate every day.
Absolutely. Before we sign off, is there anything that you're looking at now? Is there any opportunities that our listeners can participate in? And secondly, if there are type of syndications that you're looking at or open funds, what type of syndications are they? Do they need to be
Accredited?
Accredited, or are you looking at more of a crowdfunding type of a situation? Or
yeah, so the best thing to do if you're listening, you're like, hey, I'd like to learn more about what we do at Next Level Income, go to the website, click on the invest link. Mm-hmm. And you can schedule a time for us to have a conversation. We currently have a multifamily deal. I'm not sure when this is going to air, but we'll be closing on that deal in Charleston at the end of August. It's a wonderful property down there in Charleston. It's actually the site or the area where I did my first multifamily investment was in Charleston, South Carolina. So I got a real soft spot in my heart. I love to take the family down there. It's about 4 hours from Asheville. We just launched a self-storage fund. So I think self-storage is going to do very nicely alongside multifamily for the future as we see more people moving. They say, hey, I'm more mobile because of COVID. I can use Zoom like we're doing today, Mike. And, they're going to put their stuff in storage. Baby boomers downsize. We have some great properties that we've acquired and put into that fund. And we have some other stuff as well. So the best thing to do, check us out, nextlevelincome.com. Get a copy of our book for free. Check out the invest link if you're interested in learning more.
Sounds great, Chris. It's been absolutely wonderful. I appreciate a lot of great information, and I'm sure our listeners are going to be typing away at learning a lot more about Next Level Income and everything that you do. And especially, guys, listen, remember the free book. Go to Next Level Income and pick up your copy. You won't regret it. Thank you, Chris, and thank you, everyone, for listening. Take care.
Mike, it's been my